Our next guest warns of uncertainty ahead, says the outlook for next quarter could spell some trouble given some of these weakening tailwinds for stocks and some rising macro concerns. Joining us here at Post 9 this morning is Barclays head of U.S. equity strategy, Venu Krishna. It's great to have you. Venu, welcome.
Thanks for having me back.
Sarah mentions some of the things in the micro and the macro, the revisions, PMI, some of the BLS numbers. Do you have a preference about the size of the cut if we get one?
We think it's going to be a quarter point, and we think it's going to be 3 cuts. And the view I've held, at least, is that be careful what you wish for. More aggressive cuts certainly herald a bigger problem waiting. And so a scenario in which you see steady cuts but smaller cuts is far better for the economy and especially for the equity markets than big moves. And obviously, those moves are not independent. They are driven by what's happening in the labor market and hence what's the impact on the economy. So I think it's an interesting environment we are in right now.
How impressed have you been about equity's ability to outperform other macro tells like commodities and bonds? Is it about technology? And if so, is that at risk given some of the commentary lately?
So I think I'll answer it in 2 parts. First is, interestingly, equity markets have been more right than most other risk assets and the treasury market over the last, call it, year and a half, right? And so credit goes to the equity markets in that respect. The second part, is it all about technology? Yeah, a good part thus far has been all about technology, and especially big tech, which is a group of only 6 stocks, the way we define it. So yes, but I think since Q1 of this year, we have seen early green shoots of some incremental improvement outside of big tech, which is a very healthy sign. But I think where the caution comes in is that the pace of improvement people have been expecting is, I think, a lot more than what is actually being delivered. So I think it's going to be a very steady and slow process. It'll probably go more into 25 than this year. But overall, listen, if you look at the earnings season, for example, at the top of it, a lot of healthy signs, the best earnings growth you've seen in 2 years, positive operating leverage in which sales growth is less than earnings growth, so that's a very healthy sign. But there are red flags, right? So the numbers for 3Q have been cut quite sharply, and yet the numbers for subsequent quarters have been untouched, which tells me that there's clearly a fair amount of macro uncertainty. The other way to think about macro uncertainty is if you look at what the derivatives market is telling you, look at the forward S&P wall curve over the next month, NFP is the biggest event. And the move related to that in S&P is more than what has been realized in the last, call it, 2 odd years. So I think labor market and hence its implication on growth remains a critical element right now in the markets.
What about tech? I mentioned NASDAQ being higher today. Mm-hmm. For the first time in a while. It's still down almost 3% for the week. It really has set the tone for stocks lately, also as obviously the biggest sector and the swing factor for the S&P 500. Yeah. Is the valuation reset? Do you think it's been done? Do you think we've washed out positionings, or do you see more of the pain for the group?
I would say that valuations have corrected quite healthily, but I don't think we're out of the woods. So if you were to think about the sheer scale of it, big tech, which has been driving almost 25% of the earnings growth in S&P, their valuations had peaked at 34 times forward earnings. And then during the correction we saw in July, August, they dipped to about 27 times. The bottom has been 25 times in the 22 sell-off, right? So I think right now we're sitting at roughly 29 times. I am a little concerned because I think tech, what has happened is the torrid pace of earnings growth from big tech is clearly moderating, right? It's moderating at a healthy clip. So we saw 2 quarters of moderation. It's expected to have another level of moderation and then settle in around the 20% level. If that is indeed what plays out, and we are quite hopeful about that, then paying a multiple in the mid to high 20s is quite reasonable. But there is some risk to that. And so I think the minute big tech as a group, when it goes above 30 as a group, I think there is some reason for you to be more cautious about what you can expect. And the last thing I would say is, I think I mentioned it even last time, remember that when big tech corrects, correlation increases. and so does the rest of the market. So, it's all linked. But overall, tech valuation corrections has been healthy and much, much needed.